What if 90% of people who think they're smart investors are actually destroying their wealth? Not because they're stupid, because they're playing a game they mathematically cannot win. For 10 years, I've been tracking two groups of investors. Same starting amount, same time period. One picked individual stocks. The other bought boring index funds and did nothing. The results aren't even close, and they're going to change how you think about investing forever. I'm talking about real money, real people, real 10-year track records. Here's a question most investors get wrong. Over the last 10 years, what percentage of professional fund managers actually beat a simple S&P 500 index fund? Take a guess. 50%, 40%, try 11%. Only 11% of professional fund managers beat the market over 10 years according to the SPIVA Scorecard. These are people with decades of experience, Ivy League educations, billion-dollar resources, access to information you'll never have, and 89% of them still lost to a fund that just buys everything and does nothing. If the professionals can't beat the market, what makes you think you can? I'm not being mean. I'm trying to save you hundreds of thousands of dollars right now. Let me show you what actually happened. Two investors in January 2014. Both have $10,000 to invest. Both are 30 years old. Both committed to adding $500 monthly. Investor Alex is convinced he can pick winning stocks. He reads financial news daily, follows market gurus, analyzes charts. He's doing his homework. He's being smart about it, right? Investor Beth buys a simple S&P 500 index fund and sets up automatic monthly contributions. Then she basically forgets about it. She checks maybe once a quarter. That's it. 10 years later, Beth, who did nothing, has approximately $128,000. That's her initial investment plus monthly contributions plus market returns. She's happy. She's stress-free. She's wealthy. Alex, stock picking results vary wildly. But data shows most individual stock pickers underperform the market by 3% to 5% annually. Let's be generous and say only 3%. Instead of $128,000, Alex has around $108,000. That's a $20,000 difference in just 10 years. But it gets exponentially worse when you extend this over a lifetime of investing. A study by Dalbar found the average individual investor underperforms the S&P 500 by 4% to 6% annually. Why? Let me show you with real examples from the decade. Remember 2014, GoPro went public and people thought it was the next big thing. It hit $93 per share in October. If you bought then and held, it's now $1 to $2. That's a 98% loss, while the S&P 500 more than doubled. Or Fitbit in 2015, the hot stock everyone wanted. Peaked around $50 per share, now acquired, early investors lost everything. You might say, but what about Apple or Amazon? Great question. Apple is up over 800% in 10 years. Amazon over 1,000%. Those crushed the market, right? Here's the problem. For every Apple, there are dozens of stocks that went nowhere or disappeared entirely. Individual investors are terrible at picking the Apples and Amazons consistently over time. Research by Hendrik Bessembinder shows that from 1990 to 2020, just 2.4% of stocks accounted for all the market's net gains above treasury bills. Just 2.4% created all wealth. If you're picking individual stocks, you need to identify and hold that tiny 2.4%. And avoid the 97.6% that underperform or destroy wealth. What are your actual odds of doing that? The math is brutal. It's like going to a party with 1,000 people. 24 are billionaires who will give you money. The other 976 will take money from you. Twitter in 2014 was trading around $50 to $70 per share. By 2024, before going private, it was around $54, basically flat for a decade, while S&P 500 was up 180%. General Electric, once America's most respected company. In 2014, it traded around $26 per share. By 2024, after reverse splits and restructuring, it lost more than half its value. In 2017, everyone talked about blockchain stocks. Riot Blockchain went from $8 to $40 in months. People felt like geniuses. Then it crashed to under $2 by 2019. It went back to $65 in 2021 during the crypto boom. Then crashed again to under $5 in 2023. If you bought and held from 2017, you're basically even or down. Meanwhile, boring index fund investors who bought in 2017 are up over 100% with zero stress, zero volatility, and zero time spent researching blockchain technology, zero drama, maximum returns. Let me show you why stock picking fails. There are 6 reasons, and all are proven by 10 years of data. Understanding these will change your investing life forever. Reason 1. Survivorship bias. You only hear about winners. Every year some stocks go up 500%. Those are on magazine covers. Nobody talks about hundreds that went to zero. In 10 years, thousands of stocks were delisted or went bankrupt. Sears, Radio Shack, Toys R Us, Bed Bath & Beyond. If you own those individual stocks, you lost everything completely. If you owned an index fund, those losses were tiny blips automatically replaced by better companies. The index heals itself. You don't have to do anything. It's automatic protection. Reason 2. Timing. Even if you pick the right stock, you must buy at the right time and sell at the right time. Get either wrong, you lose big. Netflix over 10 years is up massively overall. But there were periods where it dropped 75% from peaks. Buy at the top, sell at the bottom, you get destroyed completely. In 2022 alone, Netflix dropped from $700 to $200. People who panicked and sold locked in 70% losses. Index fund investors saw only 18% drops due to diversification. Reason 3. Fees and taxes. Every time you trade, you pay. Every time you sell a winner, you trigger capital gains taxes. This compounds against you over decades. Active stock pickers trade frequently. Studies show individual investors turn over portfolios at 75% or more annually. That means constantly triggering taxable events every single year. It's expensive. Index fund investors hold for decades, deferring taxes. Over 10 years, the difference between paying taxes annually versus deferring them adds 1% to 2% in additional annual returns. Reason 4. Emotional decisions. This is the biggest killer. Humans are terrible at investing because emotions sabotage us. We buy when excited, price is high. Sell when scared, price is low. The 10 years from 2014 to 2024 gave multiple panic chances. December 2018, market dropped 20%. March 2020, it dropped 34% in weeks. Late 2022, down 25% from highs. Individual stock pickers watching their specific stocks drop 40% or 50% panicked and sold. Index fund investors who stuck to their plan recovered every time and ended up far ahead. Data from Fidelity showed their best performing investors were people who forgot they had accounts. Dead people and people who forgot passwords outperformed active traders. Think about that deeply. Reason 5. Concentration risk. When you pick individual stocks, you own 10 to 30 stocks. Index funds own 500 or more. One bankruptcy means 10% loss versus 0.2%. Over 10 years, diversification is the difference between sleeping well and having panic attacks. I've seen people lose 50% of retirement in their employer's stock. Enron, Lehman Brothers, General Electric. Reason 6. Overconfidence. Early success makes people think they're good at this. You pick a stock, it goes up 50%, you think you've got the magic touch now. Then you get bolder, put more money in, take bigger risks. Eventually you pick wrong. One bad pick can wipe out years of gains. This pattern repeats constantly with individual investors. Let me show you exact numbers over 10 years with real scenarios. You invested $100,000 in January 2014 in S&P 500 index fund and never touched it once. By January 2024, you'd have approximately $317,000. That's a 217% return, about 12.2% annualized. Not spectacular, but solid and consistent. Now let's compare other approaches to this baseline. Same $100,000, but you tried timing the market. Sold during December 2018 correction, missed the best 6 months of 2019, sold March 2020, missed the massive recovery rally. Studies show missing just the best 10 days in the market over 10 years cuts your returns by more than half. Miss those days, your $100,000 is worth $155,000. That's $162,000 lost because you were trying to be smart. You didn't lose to bad luck. You lost to the mathematical impossibility of timing the market consistently over time. You invested in individual stocks based on tips, news, and trends, some winners, some losers. You underperformed the market by 4% annually, which is typical for individual investors. Instead of 12.2% annually, you earned 8.2%. Your $100,000 would be worth about $218,000. You still made money, but you left $99,000 on the table by being clever. Monthly contributions comparison, how most people actually invest. You contribute $1,000 monthly starting January 2014 through December 2023. That's $120,000 in total contributions over the decade. Index fund investor. Your account is worth approximately $223,000. That's $103,000 in gains on your $120,000 invested. An 86% return on your contributions with zero effort or stress. Stock picker underperforming by just 3% annually. Your account is worth approximately $198,000. That's $78,000 in gains. You left $25,000 on the table by trying to be clever. Now extend that over 30 years instead of just 10. That $25,000 difference compounds into hundreds of thousands of dollars lost. This is why this matters so much for your future. Professional investors spend 60 to 80 hours weekly researching stocks. They have teams of analysts, access to company executives, sophisticated models, and real-time data feeds nobody else has. You're competing against them with what? A Robinhood account and some YouTube videos. Be honest with yourself. What edge do you actually have over these professionals with unlimited resources? Even if you have special knowledge, the market has probably already priced it in. Markets are incredibly efficient. By the time you hear something, thousands of traders already know. Vanguard tracked investors over 10 years. They found 82% of individual investors who tried picking stocks would have been better off in index funds. 82% failed to beat simplicity. That means if you're picking stocks, you have less than a 20% chance of beating a strategy requiring zero skill, zero time, and zero stress. Those aren't good odds. Warren Buffett picked stocks and became a billionaire, right? True. And you know what he recommends for regular investors? Index funds. He practices one thing, preaches another for good reason. He's instructing the trustee of his wife's inheritance to put 90% in a low-cost S&P 500 index fund. The greatest stock picker of all time tells you not to pick stocks. Some say stock picking is more fun, more exciting. I get it. Picking stocks feels like you're doing something. Index fund investing feels passive and boring to most people. But here's the question. Do you want to have fun, or do you want to be rich? Because the data over the last 10 years is crystal clear about this. Boring wins. The most successful investors I know personally are not exciting people. They don't have crazy stories about timing the market perfectly. They set up automatic investments decades ago. Now they're millionaires. Here's your exact step-by-step strategy that 10 years of data supports. This is what actually works. What actually builds wealth. What actually creates financial freedom over time. Here we go. Step 1. Open an account with a low-cost brokerage. Vanguard, Fidelity, or Schwab. All three have index funds with expense ratios below 0.1%. That's under $10 yearly per $10,000 invested. Step 2. Choose a simple index fund. For most people, a total stock market index fund or S&P 500 index fund is perfect. Want more diversification? Add total international stock. A simple portfolio, 70% US total stock market, 30% international total stock market. That gives you exposure to thousands of companies across the entire world automatically and efficiently. Step 3. Set up automatic contributions. Every month, have money automatically transferred from checking into your index funds. This removes emotion from the equation completely. You never think about it. You're buying when the market is up. You're buying when it's down. Over time, this dollar cost averaging smooths out volatility and ensures you're always invested in the market. Step 4. Increase contributions annually. Every raise you get, increase your automatic contribution by 1% or 2%. You won't miss money you never saw, but it compounds into enormous wealth. Step 5. Never sell. This is the hardest part. When the market drops 20%, 30%, or 40%, you will want to sell. Every instinct will scream to protect your money. Don't do it. Data from the last 10 years shows every single crash recovered. Every single one. People who sold locked in losses. People who held and kept buying got rich. March 2020 is the perfect example. Market dropped 34% in 3 weeks. People panicked, sold, went to cash. Thought they were being smart and protecting their hard-earned money from disaster. Market recovered all those losses within 5 months. Sold, you locked in 34% loss. Held. Back to even by August 2020. Kept buying during crash. You made a fortune on the recovery. Step 6. Rebalance once yearly. If your allocation drifted from 70/30ths to 75/25ths, sell a little of the winner and buy the loser. This forces you to sell high, buy low automatically. Step 7. Ignore the noise. Turn off CNBC, Unfollow stock gurus on social media. Stop reading articles about the next hot stock. All designed to make you feel like you're missing out. You're not missing out, you're winning. While everyone else chases trends and loses money, you're quietly building wealth that will set you free. Boring always beats exciting in investing. Always. If you found this helpful, subscribe because I break down complex financial topics with real data and no BS. The market rewards patience, discipline, and diversification. The last 10 years prove this beyond any doubt.